What if I told you, the biggest threat to your wealth isn't the market? It's you? And this one mistake is silently costing investors thousands, sometimes millions, without them even realizing it.
All right, let's just jump right in. We spend so much time and energy trying to find the perfect stock, right? The next big thing, some complicated strategy to beat the market. But what if I told you the real secret to building wealth has almost nothing to do with any of that? Today, we're going to dig into a really simple but honestly a profound idea. The greatest returns don't come from mastering the market, they come from mastering ourselves. It's a tough question, isn't it? After all that work, all the research, to think that the one person most likely to wreck your financial future is the one you see in the mirror every morning. And look, this isn't about being smart or dumb. It's about our own human nature, how we're hardwired. And as you're about to see, this is a problem that affects everyone. And this isn't just a theory. According to a veteran fund manager, Vijay Mantri, this impulse is totally universal. It doesn't matter if you're a slick investor on Wall Street or just starting out in a small town. The exact same instinct kicks in for all of us. We see something that's doing really well, and we just want in. We can't help but chase what's already hot.
And this feeling, it actually has a name. It's called recency bias. It's that little voice inside your head that whispers, hey, this fund has been going up for a year straight, it's gotta keep going up. It feels like a smart shortcut, but in the world of investing, it's usually a one-way ticket to buying high and, you guessed it, selling low. This one little bias is responsible for a massive, hidden cost in most people's portfolios.
So this leads us to something that, honestly, it shocks most investors when they first hear about it. It's called the performance gap. This is the difference between the return a fund says it got and the return the average investor in that fund actually gets. And believe me, that gap can be huge.
So imagine you see this headline. A mutual fund has this incredible track record, right? An average return of 19% a year. The immediate reaction for most of us is, wow, I gotta get a piece of that action. It seems like a total no-brainer.
But then you dig into the data and you find a really painful truth. Even though the fund itself made that amazing 19%, the average person who put their money in it only made a tiny fraction of that. We're talking maybe 4 or 5%. So where did all the money go? The fund didn't lose it. It was lost because of the investor's timing. I know, it seems like it completely defies logic, right? How on earth can a fund do so well while the people in it do so poorly? Well, the answer lies in that predictable, emotional cycle of human behavior. It all comes down to this classic trap. See, a fund starts out small and has a fantastic run. Then the buzz starts to build. Everyone sees those amazing past returns, and driven by that recency bias we just talked about, a huge flood of new investors pours their money in, right at the very peak. And of course, nothing goes up in a straight line forever. So when the market eventually corrects, it's that huge wave of latecomers who get hit the absolute hardest.
So if our own brains are wired to make these very mistakes, what do? How do we fight back? Well, the solution isn't a fancier algorithm or a secret stock tip. It's about completely reframing how we think about getting financial help.
You know, most of us have been taught to think that a financial advisor's job is to be some kind of stock-picking genius, right? To find us the next Google or Amazon. But the data shows that trying to consistently pick winners is, well, it's pretty much impossible. The real value, it lies somewhere completely different. Instead of a stock picker, the best advisors act as behavioral coaches. Their main job isn't to manage your portfolio, it's to manage you. They are the circuit breaker between your emotions and your wallet. They're there to stop you from making those expensive gut reaction mistakes. It's a huge shift in thinking. You're not paying them to beat the market, you're paying them to stop you from beating yourself.
And as Mantra says, being disciplined is painful. It feels wrong to buy when everyone else is selling in a panic, or to just hold on when your portfolio's bleeding red. A good behavioral coach gives you the support to get through that pain, because on the other side of that discomfort, that's where the real wealth is made. Their edge is making sure you stay in the game long enough to win.
Now, I can hear what you're thinking. Okay, fine, but can an AI just do this for me now? I mean, with all these powerful algorithms we have, can't technology be our coach just as well as a person? It's a fair question, so let's break it down. Think about it. An AI, by its very design, just looks at past data. So when you ask it for the best funds, what's it going to show you? The funds that just did well. It literally reinforces the exact recency bias we're trying so hard to avoid. A human coach, on the other hand, can give you context. They can talk you down from the ledge and remind you why you started this journey in the first place. They manage the fear, not just the data. Let's make this really simple. The market is in an absolute freefall. Your life savings have just been cut in half. In that moment of pure, gut-wrenching panic, do you want to get a push notification from an app? Or do you want to hear a calm, experienced human voice on the phone telling you, hey, we have a plan, stick to the plan, we prepared for this? That kind of trust is something an AI just can't replicate. Okay, so we understand the problem. We know why a human coach is so valuable. But how do we actually put this into practice? What's a simple, solid plan to avoid these traps and just get started? Well, it all begins by changing our expectations.
First things first, we have to get this idea out of our heads. Chasing those insane 20 or 25% annual returns is what gets people into trouble. It's what fuels that whole cycle of chasing trends and making reckless bets. It's like they say, you see a lot of bold drivers, but you don't see a lot of old bold drivers.
The real secret weapon, the most powerful and frankly most underrated force in investing, is simply time in the market. Not trying to time the market, but just time. The goal isn't to have one spectacular, flashy year. It's to have decades of steady, boring, uninterrupted compounding.
So what's a realistic number to shoot for? Well, the experts suggest aiming for something around 12% per year, on average. Now I know, 12% doesn't sound nearly as exciting as 20%, but what this number can do over the long haul, it's nothing short of magic.
And this is where that 12% becomes absolutely magical. The source material gives this stunning example. If you invest consistently for just 20 years and you earn that 12% average return, you could then stop investing. Cold turkey. And from that point on, you could start pulling out a serious income every single month for the next 40 years. And because of the raw power of compounding, your original nest egg might not even shrink. I mean, how incredible is that? That's what longevity gets you. So how do you actually build a portfolio that aims for that kind of steady, long-term growth? Well, the source material lays out a really simple, diversified starting point for us. The big idea here is just diversification. Don't put all your eggs in one basket. So it suggests putting 20% in large cap funds. Those are the big, stable, blue chip companies. Then 40% goes into mid and small cap funds for that higher growth potential. And the last 40% goes into flexi-cap funds, which basically gives the fund manager the freedom to hunt for opportunities across companies of all sizes. It's a really balanced approach built for the long haul. And finally, here's the smart way to get that money invested. Instead of just dumping it all in at once and praying you pick the right day, the smarter move is to first put the lump sum into a very low-risk fund, something like an arbitrage fund. Then, from there, you set up an automated plan, it's called a systematic transfer plan, or STP, to drip-feed that money into your chosen funds, bit by bit, over 6 to 12 months. This automates your discipline and makes sure you don't accidentally buy everything at the top of the market. So, there you have it. We've gone through the what, the why, and the how. You now have the blueprint to sidestep the single biggest trap that trips up most investors. The knowledge is all here. But the final variable, the one that truly determines your success, it all comes down to this one simple but very challenging question. Do you have what it takes to stick with the plan?
Because in the end, the market doesn't beat most investors. Their own behavior does. If you want to master your money instead of letting it control you, hit subscribe now. Because the investors who win aren't the smartest, they're the most disciplined.